Ladies and gentlemen, if you'll just bear with us, we still have a few people that are coming through security, so we'll start in a few minutes. Thank you.
Oh. You shot like that, man. You shot like that.
Yeah, very nice. To the point.
Gone is not your share.
Yeah, do that.
Anything for you. That's why I keep it up. It's not your share. Cut down. What about you? That kills me. I don't think there's anything better than you.
Good evening, ladies and gentlemen. Before we commence with this evening's program, I'd like to take you through a few housekeeping issues. I kindly request that you activate silent mode on your cell phones for the duration of this evening session. On page 29 of the notebook that you would have received when you either arrived or at the registration desk, there's a feedback form. We value your feedback and we request that you complete this form and hand it in at the registration desk when you exit the venue. At the same time, please collect a copy of the April 2019 Monetary Policy Review booklet. This is a biannual publication and is aimed at broadening public understanding of the objectives and conduct of monetary policy. I request your indulgence to allow me to highlight procedures to be followed in the unlikely event of an evacuation of the building. There are 3 primary exits, one on the southeastern side, at the general reception area under the glass dome, clearly marked as Exit A. There is another exit next to the lifts, marked as Exit B, and a third exit on the northern side, down the stairs, past the conference and syndicate rooms, marked as Exit C. Evacuations will be initiated by a siren or an address over the public announcement system. Please do not panic during evacuation. Follow the guidance of the conference center personnel and the protection officers who will lead you to the designated assembly points. Now that we are done with the housekeeping issues, it is my pleasure to extend a warm welcome to all our guests and stakeholders for the first Monetary Policy Forum of 2019. We also welcome our guests who are also seated in the overflow area that is located at a venue just outside. We thank you for braving the afternoon peak hour traffic, and this provides you with an opportunity to interact directly with the South African Reserve Bank. It is indeed a pleasure to call upon the host for this evening session, the Governor of the South African Reserve Bank and the Chairperson of the Monetary Policy Committee. Governor Kanyako, I now hand over to you.
Thanks, Deshanda. I thought you would welcome me back as well. Good evening and welcome to this Monetary Policy Forum. We are fresh, some of us, from Washington, D.C., where we attended the meetings of the IMF and the World Bank. There are a couple of microphones that are on. Can you switch them off? Then you will have peace. Yes, thank you. And the discussions were, of course, dominated by what is going on with the global economy, and that overall the take is that the growth in the global economy is continuing, albeit at a slower pace than we had seen when we last met in October of last year, and that European growth, which is what really matters for South African growth, is weaker than was initially thought, and that the balance of risks to the growth outlook are actually on the downside. And that on the inflation side, that inflation in the developed economies remains well contained, and that it is still way below the targets of those particular economies, which is why you had seen a pause coming from some of the major central banks in terms of policy normalization. Central bankers are pretty precise with language and underline the word pause, meaning that we'll continue to become data dependent, and we would like to see what data could actually change the way in which we look at things. Of course, with that, what that meant was that risk assets are starting to be attractive again, including the assets from the emerging market economies, and that has given some respite. Because one of the big risks that was identified as we were coming to the close of the previous year was tightening global financing conditions. And the resumption of flows to the emerging markets means that those conditions are less tight than they were the last time. That means that it gives space for emerging market economies, that you should not then once again binge on the availability of money that is cheaper than what it was in the previous year, but that you use that space to actually embark on the necessary reforms so that the potential growth rates of the economies would rise. That is the global backdrop. I wish I could tell you a little bit more about the South African economy, but that is the beauty of being a governor. You employ very clever people who know about the economy to talk on your behalf. So, Dr. Lovald.
Thank you. I'm in a bit of trouble tonight. I've come to you with a slightly longer presentation than I normally do. And I've got some members of the panel who are very keen to watch soccer tonight, and other members of the panel that I'm worried might fall asleep because they've been on planes for the last 24 hours. So I'm going to move, as I usually do, pretty quickly through this presentation. We've titled the Monetary Policy Review Towards Permanently Lower Inflation. And we're certainly hoping that we get there. The headlines that I want to put out are that global growth has slowed. This has had a direct impact on monetary tightening, something I'll show you shortly. South Africa's growth rate, we expect to be modestly higher over the medium term, but the trend rate is low, and I'll talk quite a bit about where our forecasts have been wrong about growth and why. Near-term inflation is turning out to be quite a lot slower, largely due to some pretty helpful shocks. Obviously, that is very good for our overall inflation rate and has really kind of flattered that inflation rate quite well over the past 6 months and into the first few months of this year. But we worry quite a bit about some upward pressure on those inflation numbers, and I'll show you what those look like later on. What does this all mean for the interest rate path? Well, it keeps it pretty modest, which you should be seeing, and we're going to hope that it keeps our longer-term inflation rate close to that midpoint. So we've talked quite a lot in recent times about the need to move away from a 6% inflation rate, which we've been achieving over some time, and move towards 4.5% and the various kinds of economic benefits that would provide. And we think we've got the right kind of interest rate path to get there, and I'll show you what that looks like. So the global economy is slowing again. The governor spoke about this. On the left-hand side, you can see world growth and what the IMF's World Economic Outlook shows that it will transition to over the next couple of years, just those dotted things. And you can see that this is quite a bit of a slowdown, but we're actually at a pretty good level generally. 3.8 for last year was quite strong, as you can see. So there is this slowdown, and it's worried people quite a lot. But we're not talking about a complete collapse of growth. As you can see here, we're talking about 3.3, 3.4% for the year, and that's not too bad. When we look at the global composite PMI on the right-hand side, again, this looks pretty scary because you've got quite a steep decline here, but you need to look at this in level terms. The index here I'm showing you, it doesn't show a massive drop, and that's quite an important feature of what's going on out there. So why is the global economy slowing down? Part of the reason has been that there's been a very abrupt deceleration in China, accompanied by the typical stimulus response. China seems to go through periods of instability followed by stimulus to try to get the growth rate back up. You can see the Goldman Sachs current activity indicator, that shows you that slump happening right in the last sort of 6 months of 2018. Then you can see a little bit of a tick up more recently as the stimulus has come in. This is a graph just showing you what that stimulus kind of looks like in policy terms. This is a short-term interest rate. And you can see what they've done here. They've cut it by roughly a third. So it's quite a sharp monetary easing that they've gone through. So there are some problems with what's going on in China, which of course everybody out there will watch very carefully. One of the difficulties has been, and one of the reasons for why there's been more caution in the global discussion about what's going to happen over the course of this year for the economy, is that some of that stimulus seemed to be blunted. And one reason why there's that kind of lack of really strong pickup of the Chinese economy has to do with the level of corporate defaults in the country. As you can see, those have picked up to quite a high level. We can see this in a different way when we look at, well, what happens to the stimulus and where does the money go? I'm showing you here this AA and AAA rated bonds issued by Chinese corporates and state-owned enterprises. The red, the AAA, is the state-owned stuff. And so what happens when the Chinese stimulus comes along, if there's a high level of risk, the money starts to flow into those guaranteed state-owned enterprises rather than into the private sector. So the private sector's interest rate has ticked up a little bit. It's still kind of stable. It hasn't picked up too much. But you can see in the ways in which the Chinese stimulus is not having quite the impact that one would have wanted it to have, and I'm sure the Chinese authorities expected it to have. Chinese debt levels are a long-standing problem. Temporary shocks hitting particular European economies. Germany in particular suffered a range of issues of late relating to a variety of things, including their emissions problems with their cars. France has been hit by a series of protests. Italy, I think, is pretty well known, slow growing. My apologies to the Italian embassy group here. I saw them come in earlier. But Italy's having some struggles there with a variety of economic problems of quite long duration. But it's feeding into, at this current point in time, quite a sharp deceleration in the overall euro area GDP growth outcome. And that obviously impacts on the global economy in quite a big way. Brexit uncertainty is also a problem. I'm showing you here on the left just a graph with the percentage of firms reporting that Brexit is in their top 3 sources of uncertainty. So a lot of the data we get is this kind of survey-based data, what worries you a lot. And you can see that nearly 60% of firms in Europe are reporting that Brexit is bothering them. And we can see why on the right-hand side, euro area exports to the UK have really dropped off over the last couple of years and were negative in 2018. So what does this all mean for Europe as a whole? Well, it's fed into a discussion about or move to actively postpone monetary tightening plans. Euro area inflation expectations factor in those growth outcomes that we were just looking at, and you can see how these have shifted down quite substantially between September of last year and March of this year. That's quite a significant drop. And the probability of an ECB rate hike, which was quite high, well over 50% as of March already, has come down just over a month later to 0. At the same time in the US, stimulus has faded, growth has been slowing for a while. You can see the US economy got up to very high growth rates in 2018, but have come down quite a lot. Again, like the world economy, this is not a massive crash. We shouldn't think about it that way, but it is certainly a slowing down relative to potentially higher than could have been extended growth rates in 2018. On the right, we're showing you what the nowcasts look like for Q1 and Q2 of 2019. So this is explain this a bit. December 7th, 2018, the nowcast for the growth rate in 2019 Q1 was still up at 2.5%. That persisted for quite a long time into 2019, and then again, like in the European situation, it tailed off very strongly. So these are very short-term forecasts, what's growth rate going to be in the very near term, and you can see that these have tailed off. More encouragingly, the Q2 nowcast has strengthened, and that's obviously a good sign for the US economy and the global economy generally. US inflation has been undershooting its target again. You can see that very clearly here, where the inflation target is up there, but you've got the PCE and core PCE coming out quite a bit weaker. This happened earlier. There was every time the inflation rate starts to pick up, monetary policy tightening in the U.S. is forecast, and it just hasn't come to fruition, and we're just seeing that again. That pause in expected tightening by the Fed has helped to loosen financial conditions. And you should think about these financial conditions not just being US specific, they're global. Again, you can see how that inflation rate going up and market commentary about what the Fed was going to do, the Fed's own communication started to tighten those financial conditions, and then we get this collapse again as the growth rate, as the inflation rate comes out weaker. Projections for U.S. interest rates, you can see how those have shifted down quite a lot. So for emerging markets, of course, as Lisette said, this has kind of improved things. It does suggest that there's an easier environment for emerging markets out there. The left-hand side just shows you on a net basis and excluding China, the way in which capital has moved in recent times, non-resident portfolio flows to emerging markets. And you can see there was quite a sharp pulling out when people felt that the Fed was on track to continue tightening and the U.S. economy was growing very rapidly. And that generated this kinds of outflows out of emerging markets, and that's reversed quite neatly there. The graph on the right shows you another version of that. That's your emerging markets currency index. So the long period of weakness on the right-hand side has been reversed in the last few months. For emerging markets generally, the inflation rate is lower. I'm showing you this on the left-hand side, where we've got two different versions of emerging markets. The black includes Argentina, Nigeria, and Turkey, which are three emerging markets with quite high inflation rates in recent times. And when we strip them out, you get a much nicer kind of gradual disinflation going on in the rest of those emerging markets. The bottom includes all the ones including in there, including South Africa, of course. That has generated, in turn, a quite sharp shift in what countries are expected to do in terms of policy. And so you could see, as of the second half of 2018, the number of countries that were going to hike was quite high. Quite a few were on hold, but that hiking number is over 50%. And then by the first half of 2019, that has shifted quite a lot. That inflation easing has generated expectations of cutting even, and so the market's expectations of how many countries would cut continues to grow into the second half of 2019 for emerging markets as a group. Some emerging markets have fared better than others in this whole process of dealing with the volatility of the global economy and the shift in expectations about monetary policy tightening in the US and the EU. Some of the countries that had to adjust quite abruptly and suffered big growth decelerations to get their external imbalances in order are Turkey and Argentina. You can see them here on this quadrant. So this is where they had very large improvements between 2019 and 2017 in their current account balances. That's shown on the left-hand side. And then on the right, on the bottom here, the horizontal axis is the change in GDP. You can see both of these countries went through quite a sharp deceleration to try to get those external imbalances in line. We talk about this a bit more. There's a box on it in the NPR. Again, we show you Turkey and Argentina in a little bit more detail on the right-hand side graph. Again, just another version of what these countries kind of went through. GDP growth, this is the zero line for that part of the graph. So you can see both Turkey and Argentina went into quite sharp decelerations. By contrast, India and Brazil are a couple of countries that have done very well. Recently, they've had significant disinflations. I'm comparing them here, India and Brazil, to South Africa to give you a sense of the scale of the disinflations that they've gone through. And they have quite successfully also pulled down 1 year ahead inflation expectations in that process. So this is Brazil's. It had quite sharp depreciation, which generated an inflation rate, and then it's come down. Their control of that has resulted in a very sharp decline in forward-looking inflation expectations. They also didn't get too badly hit on the growth side. In fact, this graph shows you that there was essentially no growth loss for those disinflations. And so those economies did very well, presumably in terms of their credibility of their monetary policy and the way in which they communicated what they were doing. So what does that leave for the rest of the emerging market universe? Well, there's some scope for emerging markets to continue to accelerate. I'm showing you that on the left-hand side. The global expectations for growth are here, this blue. If we just look at emerging markets, we get to that red. That's excluding China. But you see quite a nice sort of tick up in that emerging market. Let's see if this thing is working here. And then if we unpack the countries in which this is happening on the right-hand side, you can see that Nigeria, which is this green, Russia, the blue, Brazil, the dark blue here, even South Africa, all are expected to accelerate a little bit, some obviously much more than others, and that picks up your overall emerging markets growth rate. South Africa is a bit of a laggard. We've made this kind of point before. We tend to sort of be a bit slower than some of the other emerging markets to respond to global impetuses. This will not surprise you that South Africa's growth rate has continued to lag. We continue to wait for a stronger recovery. What I'm showing you here is the black is just the actual GDP outcomes year on year. So these are the annual figures, and then compare them to what we thought would happen in the March 2018 and March 2019 forecasts. And you can see that these things have been delayed. I'm going to talk a little bit about why that's the case. So what has this meant for us? Well, certainly it's helped to push out the output gap. So we have for some years made the point that South Africa has a significant output gap, and that's the gap between what you think the economy can grow at and what you've realized in terms of growth. And we can see how from March 2018 again to a year later, that output gap has shifted out to the right. The underperformance of growth, this thing's not working, is pushing down that blue dotted line. You get this plunge in the red, and so you get the output gap pushing out from forecast to forecast in the short term, but also pushing out over time to the right. The right-hand graph shows you the evolution of the 2018 GDP forecast going back to March 2016. So 2 years ago, we thought that growth would come out at something like 1.75% for 2018. Even as of March 2018, we had a pretty good growth rate of 1.7 still. But then over the course of the latter part of 2018, we start to see some big shocks having hit the economy and much worse growth rates than expected, and we get to 0.8% on the far right-hand side. So why is all this happening? Well, one of the problems that we've experienced has been that the primary sector has been incredibly volatile, and I'm showing you this on the left-hand side. Again, these are annual numbers. They don't really show you the scale of the volatility coming from particular sectors, particularly agriculture, but also mining. But it does give you a sense of how that impacts on the total GDP. So the black is what we've actually experienced. If we take the primary sector out of these numbers, we get that green line. Now, it's not a lot better. We're not seeing growth at 2.5%, which we obviously like to see, but you can see it's a lot less volatile than overall. So the rest of the economy outside of those primary sectors has continued to move along, albeit not at a very fast rate. So another part of our story about what's going wrong here has to do with public investment. I'm showing you on the right-hand side here what we thought South Africa's investment rate broken down by government, public corporations, and private business looked like as of the January 2019 forecast for 2018. And you can see we had numbers right around zero. So those small negatives would have taken away from growth, but not in a major way. When we got the national accounts revisions, that came with it quite large revisions to the gross fixed capital formation numbers. And we can see that, in fact, the private business numbers moved slightly positive. That accounts for a large chunk of global gross fixed capital formation. But general government and public corporations, probably not a surprise to any of you, turned out to be much more negative than we had thought them to be, dragging down those overall investment rates. So that's part of the reason why our GDP numbers have been both more volatile and lower than we had expected. This just shows you a breakdown contributions to GDP growth by household consumption, gross fixed capital formation, net exports, government consumption. And those gross fixed capital formation numbers I was talking about are these yellow blocks here that have turned negative. Thank you very much. Thanks. So you can see those right there. Here's the forecast going forward. We obviously don't have a very robust expectation about growth going forward, but there is some recovery penciled in. Risks, as you will have seen from the MPC statement, the last one, are to the downside. Again, the NPR has a fairly long discussion about energy availability factors and the role of ESCOM. These numbers I don't want to talk about them endlessly because they are pretty broadly estimated, let's put it that way. I think the two things to take away are just that one of the things we worry about is that this availability factor has gone down in recent times. So that's the amount of ESCOM power generation capacity that is available at any given point in time. And then on the right-hand side, I'm showing you, and again, there's more detail in the NPR itself, a wide range of estimates of what a annual bout of load shedding might do or could do to the annual GDP growth forecasts. These ones at the bottom, I should point out, are just half-year estimates. Those are half year, and the rest, the 0.9, negative 1.1, negative 1.3 are all full year estimates. And people are actively trying to re-estimate these things now. So what does it tell us about growth? Well, we've said for some time that we worried that our growth problems are mainly structural. The graph on the left shows you the way in which we have estimated potential growth. The trend growth line is taking out some of the volatility coming from the agricultural sector in particular, but other shocks which have big impacts on that potential growth rate in the short term. So we have two growth rates here, a potential and a trend, and the trend takes out some of the volatility. On the right-hand side, I'm not sure what this graph is here, but you can see the long-term real GDP growth is that dotted line, that's 2.5%, and you can see how the economy has fared over many decades against that long-term average. And here, of course, is our more recent performance. The 2000s did pretty well. Falling potential growth also explains quite a lot of our GDP forecast errors. So in our forecast, and again in the NPR, there's a box that talks about this in some length, some depth. In our forecast areas, we every year we look back at what we got right and wrong with inflation and GDP. One of the things that concerned us is that even though we felt that demand in this economy for quite a long time should have been more robust, and the supply side of the economy should have been responding to that in quite a good way, it wasn't. And what that shows up as a forecast error here for us. And so you can see roughly between 2012 up until 2016, we were expecting much stronger growth than was transpiring. And that shouldn't really be happening unless there's something quite wrong going on underlying in the trend growth rate. So how would we want to explain that? Well, it is a bit confusing because on the one hand, gross fixed capital formation has remained relatively high. I'm showing you this as a percentage of GDP and relative to a post-democracy average, which is here about 19%, 18.5%, 19%. And even over this kind of post-global financial crisis period, you've had actually a relatively high level of gross fixed capital formation. You've also had a current account balance, which I'm showing on the right-hand side, which has been robustly negative. And so we have been spending a lot more than we have earned and importing a lot of that from the rest of the world. But the real point is that that current account balance is a reflection of pretty strong demand in the economy or expenditure. Part of the story has to do with our national net savings rate. So even though we've been consuming a lot, we have not been saving as much as we could. And that's shown on the left-hand graph. Many of you will be familiar with this. This goes back to 1946. But you can see that basically since the late 1980s, that national savings rate has been pretty much on a one-way ticket down. A brief spell where general government had a fiscal surplus in the mid-2000s. And in the post-global financial crisis era, anyway, fiscal deficits turn up as general government debt. And of course, that debt should be generating, or in the ideal world, generating a better trend and potential growth outcome. So when we unpack what's going on there, again, I'm back to the capital stock, which is the blue, our labor force is in the black. What we get is that our implied total factor productivity, which is the residual, if you will, taking out the capital that you're adding and the labor you're adding to the labor force, we're getting a negative number, or a decelerating number over quite a long time, and then a negative in the last couple of years. What would potential growth scenarios look like if that total factor productivity was at its long-term average? You get growth rates that look something much more like that. So it has a big impact. With lower growth, a fair bit of spending going on in the economy, quite a bit of exchange rate volatility, which I haven't shown you, but you all be familiar with. That has a tendency to push up risk in the economy and push up long-term rates. I'm showing you how South Africa compares on a risk measure. This is the 5-year CDS spread against a whole range of economies. And we do very well against emerging markets that are much more volatile than us. But we're in this company of Brazil, Russia, Mexico, Colombia. But we're considerably more risky, if you will, compared to Malaysia, China, Chile, Thailand, and those kinds of economies. What has this done? Well, this higher risk level tends to push up our long-term borrowing costs. And this graph is quite interesting. What I didn't show you with Brazil and India, I could have shown you this exact same graph, and what you would have seen is that yields on long-term debt have actually come down with the disinflation. We've had some disinflation, but we haven't had that borrowing cost come down as much as we would have liked, and obviously that remains a concern for monetary policy. The current account deficit adjustment that we have had over the last couple of years, I'm showing you that on the left-hand side. So that current account I pointed to earlier as a sign of expenditure has been coming back. Part of that is a much better trade performance, but a lot of that is just the private sector cutting its consumption, imports falling, and an improvement in the trade deficit as a result of that. It is true that the terms of trade has remained relatively strong, and that's helped to flatter our export performance as well. But that current account adjustment, while in our view this would be is quite needed to help reduce risk in the economy, the one thing it has done, which has been very positive, is it's started to provide a bit more stability to the currency in recent times. So on average over the last couple of years, we've actually had a reasonably stable currency. There's some wobbles in there, but if you look at it over longer term, it's not too bad. Now, why does that matter? Well, it matters for our inflation rate. And one of the things that's driven down or pulled down our inflation rate over the last 6 months, well, this graph will show you that it goes back to about the late part of 2017. You can see how the exchange rate fed into core goods inflation through this period, 2014 through to 2017. Now that the exchange rate's more stable, this number is a lot lower. It's still stronger than we'd like it to be, but it's lower than it has been. And that has generated better headline inflation rates. The oil outlook has also played some part. Again, one of the things we're worried about now on the right-hand graph is how our forecast is being pushed up a bit by higher fuel prices driven by higher oil prices. Obviously, as you know, there's lots of volatility in these numbers, and they do have quite a big impact on the inflation rate in our forecast. Another thing that's flattered the numbers generally has been that food inflation has stayed much lower for much longer than we had expected. I'm showing you here on the left-hand side our forecasts over time going back, I think, to September 2018. You can see that we expected quite a sharp rebound in food prices, which didn't materialize, and our forecasts had to be pushed out to the right. So we kept expecting food prices to go back up, partly because world food prices were expected to rise, but also because South Africa's food prices were expected to rise. And we've been surprised by that in a positive kind of way, of course. So what's turned out to be lower than expected? Well, meat certainly is a big one. You can see 2019, that red is the meat component, and it really collapses from one year to the next. So meat disinflation is having a big impact on that food price number. And world prices, bread and cereals, this orange bit here, turned out to be quite negative in 2018 and is expected to be mildly positive in 2019. Again, those prices tend to be globally dollar-driven prices. All of this has generated pretty significant shifts in our near-term forecasts. So I'm showing you here what happened to the November CPI forecast from November to March. And you can see this is a pretty large shift down. Again, don't get too excited because we only start this at 3, not at 0. So that gap goes from 5.5 to about 5. It is significant, and it's certainly a positive development that's fed through into our forecasts. What accounts for that shift down? Well, services plays a big part in it, partly because services carries a very large weight in the CPI basket. Services inflation has come down a bit. You can see food also has a very large weight, and it's played quite a big role. Energy has also played a role. And then that exchange rate driven core goods number that I talked about earlier, you can see here it's much smaller, even though it's quite volatile. Also in the NPR, we talk a bit about some analysis we do, trying to break down what's driving these changes in the CPI between pro-cyclical components and acyclical components, so those that are more responsive to demand and the output gap than others. And like some other countries that have done similar analysis, in particular the US, we get something that was a little bit unexpected. We get much more movement in our CPI inflation rate from these acyclical components than we do from these pro-cyclical components. Obviously, this is work in practice. The San Francisco Fed was the first one to do this analysis, so I encourage you to go read their work and then read what we did in our NPR. What does all this mean for the 2020 inflation rate? Well, it goes up a little bit on petrol, on food, but then back to 4.5%. So we've got quite a modest inflation trajectory driven by these positive shocks to inflation. Wages are seen to be moderating. We have what we call a unit labor cost gap in the model, which generates a gap. It's the amount of compensation that is not explained by productivity and is therefore inflationary, and that part that is disinflationary. You can see on the right-hand side our real unit labor cost gap in the forecast comes down quite neatly, driven by quite a bit of moderation in 2018. On the left-hand side, you can see that moderation here. This is from 2017 to 2018. This is the nominal growth in total compensation that the economy has seen. And you can see this is quite a sharp deceleration of this. It's not, again, massive. We're only moving from about an average of 8 to something closer to 6, but it has a significant impact. You can see there's quite a bit of volatility in those numbers as well. The good news is, and I tried to kind of presage this with the discussion on India and Brazil, one of the things that they got right was getting their inflation expectations lower. And rather pleasingly, we've seen that is starting to happen in South Africa as well. Inflation expectations are a very good forerunner of future inflation, and we can see that the easing in inflation and hopefully part of our communication has started to have an impact on those inflation expectations going forward, and that helps in our modeling process and our forecasting process pull this number down a little bit more going forward. The right-hand chart shows you how our model interprets inflation expectations and what that trajectory looks like over time. The repo path, as a result of all of that good news, is lower in nominal terms. You will know that it recommended a rate hike and then an easing later on. You can see a little bit of what that looked like compared to the two cuts that happened over the past 2 years. We had that hike here, and our model is telling us there's a little bit more disinflation needed, but not very much, all things considered. If I showed you a much longer-term graph of the nominal repo rate, you would see that this repo rate in historical terms is quite low. The policy stance the MPC has judged to be broadly expansionary. Over the period of the forecast, it will move to something more like a neutral space. This is not an exact science, but this is one of the ways in which we measure the policy stance. You can see it was very accommodative for a long period of time. The real repo rate was in fact negative, which is done in quite extraordinary economic circumstances. And then the policy became less accommodative over time. It's worth noting that this black line gets pushed up when the inflation rate goes down. So as the inflation rate eases, we get some push up in that real repo rate, and that's factored into the forward-looking forecast, of course, and the consideration of future policy rate changes. So it's a chance to lock in lower inflation, and it's a chance to do it without really much tightening in policy. We've tried to argue that that's not a bad thing for us to get to, and we seem to be getting to that place. When we look at our real ex-ante policy rates relative to other parts of the world, we're almost exactly on the median of emerging markets. You can see that on that right-hand side. You've got the median as the blue. Our real policy rate is about the same. And there are a range of emerging markets that have much higher policy rates and a few that have lower policy rates as well. The left-hand graph shows you the same thing. Well, sorry, it doesn't show you the same thing. This shows you the inflation rate. So comparatively speaking, our headline CPI is a bit higher than that emerging market median. So let me conclude with a couple of points. Weaker global economy, pick up for some emerging markets, particularly those that have managed this transition of global policy tightening in the right kind of way, in a good kind of way. South Africa's potential growth rate remains very low, and we really don't see a lot of quick fixes there. The inflation rate is at 4.5% as of today, and we think the repo path is about right in keeping it there. That path remains quite undemanding. There doesn't need to be a lot of rate adjustment so long as the shocks keep coming out being favorable. That tends to be one of the issues that we have, of course, is that we get hit by quite a lot of shocks. At this stage, it looks pretty good. Thanks.
Sounds pretty good too. Thank you very much, Chris. At this stage, I would like to invite you to pose any questions that you might have, and this distinguished panel will respond to your questions. As usual, please identify yourself and any affiliation you have, that is which organization you are coming from. Chris, you were very clear. Oh, we have got a visitor. Welcome back. Shimon.
This is a question that's coming a lot our way, so I'm
Please
going to make it...
identify yourself and your affiliation.
Sorry, I forgot. My apologies. My name is Siobhan Redford, and I am from Rand Merchant Bank Global Markets Research. So the question I have is basically, what is it going to take to cut interest rates?
Okay. We are going to take 5 questions at a time so that people can have time to think about them. Sir, at the back.
Thank you, Governor. My name is Isaac. From one of the IE institutions as a lecturer. But I'm here at my personal capacity. I don't want to be arrested. One, Governor, can we rule out the possibility of international price fixing, more especially around the oil price? Because there is a sense that that market is very much volatile and is controlled by very few elite that their task is to control the economy of the world, whereby we're seeing all this volatility and then that is hitting very hard in our economy around petrol price, even around food price. Can we definitely rule out that possibility of them fixing that price? And domestically, do we have any power, policy shift, in terms of trying to take a stand on what decisions we can take? Sharp. Second question. On this one, please, Governor, if you can definitely take out the jacket as a governor. I just want to get your view, and we all know your view around. There's currently one task team post job summit around macroeconomics. That is very key because it's going to be in the headlines as we go by, to try and see how far. I understand the mandate of Reserve Bank in protecting the rand, and I like the second part to try and sustain the economic growth. But you can see that it's not sustaining, hence the presentation. More especially around the weak capital flows and the weak demand and all those things that you've seen on the slides. Can't we try, because we've been singing the song, Governor, that independence of Reserve Bank is the key. But can't we, is it possible to change Section 223 to 226, if I'm not mistaken, so that it can suit domestic economy? Where we are right now, we're seeing ESCOM struggling, more especially around international interferences, World Bank, IMF, and the Moody's, they're always threatening us, all these agencies, because of we don't have enough funds to sustain the economy. Can't the Reserve Bank open up their doors so that they can and inject the economy of the country? Thank you very much.
Did you say the World Bank and Moody's are putting pressure on ESCOM?
No, yeah, no. What I'm trying to say is
No. Just
yes, they are putting pressure on ESCOM with fiscal.
That's
yes.
what I wanted to hear, ma'am.
Thank you, Governor. My name is Nontlanhla Ndlovu from Social Development. I'm not feeling well. Usually, after the presentation, I'm starting to feel jealous of the other countries because I realize that we're not doing well in terms of economic growth in South Africa. I understand we are facing a global weaker performance, but as South Africa, I just want to understand, what is it possible for the World Bank to play an assisting role, whereby maybe we can, the World Bank can arrange sort of like a symposium to assist us to re-engineer the economy of the country, because it's not nice as a South African to sit here and watch other countries shine. If other countries can do better, what is it that are we learning from them? Or if we are not learning at all, is it possible through that symposium to get an idea, to get that glimpse to their secrets? Because if they are doing better, we can also recover. Thank you.
Thank you, Nontlanhla. That was the third. The fourth?
Thanks for the compliment. My name is Angoma. As you have said, I'm a retired banker. My question is, how much in government paper is out there as contingent liabilities. And is it really wise for us in this situation to go out seeking more financial aids to try and build up our economy? Thank you.
Thank you. Last one in this round. No takers. Yeah, I can't see. Oh, Mr. Skese, yes.
Thank you, Governor. My name is Sekese. I'm from SNG Grand Thornton. Well done to you and the committee for keeping inflation in check. I'm impressed with that. But also I'm impressed with the future inflationary expectations, which seem to be downwards. I've got a question related to that. To what extent have we factored the element of energy and possible upward pricing on energy, especially electricity? Because my expectations is that going forward, the electricity prices are going to increase. One, then secondly, on the crude oil as well, which we've seen an upward mobility, and that those two worried me from an inflation point of view. The second one relating to the tariff war, US and China. To what extent at an economic level are we, South Africa, going to be impacted by the trade war? Because there are some commentators that the slow global economy rate is affected by the trade war.
Okay, thank you very much, Victor. Tivon's question was, what would it take to cut rates? We are not targeting rates, we are targeting inflation. Rates are an instrument to contain inflation. So, if inflation is contained, rates are contained. If you do not contain inflation, rates go up. I know you are young, but if you ask anybody in the room who lived through 1998 and ask them what were rates when inflation was 18%, they will give you a figure of 26%. Sounds like a no-brainer. You want higher rates, allow inflation to go up. You want lower rates, allow inflation to go down. So, gives you the answer, right? Thank you. Nonhlanhla, World Bank Symposium on Growth, it's an interesting one. You see, in 2008, South Africa experienced electricity blackouts. So did China, and so did India. The other two countries built the power stations that work, and South Africa called a national electricity summit. We held a symposium in December here in the bank on growth. And the decision of that symposium was that we will hold another symposium in January. And that is our problem. We know exactly what the constraints to growth in this economy are. And instead of dealing with them, we start a conversation about the problems instead of just confronting the problems. The problems are exactly the same. We published a diagnostic report with the National Planning Commission. We came with the new growth path. We tabled our own growth and we peer-reviewed it internationally, and it was right. You have really thought about these things. go do it. We just didn't do it. We said, this is a living document, so let us continue the conversation. The other countries are implementing and thus growing. Angoma, contingent liabilities of government, they are in the budget review. The last time I checked, I know about ESCOM's ones. They are 350 billion. And then you can add the others, then the contingent liabilities then gets bigger. I think a figure that was mentioned is that they are closer to 500 billion, is the figure that, that I had. So that is the contingent liabilities of government. Factoring of energy prices, fortunately, the forecast that we have has already taken into account the NERSA determination. So the forecast that we have has taken account of the electricity tariff increases that ESCOM has been given. The risk would be if those tariffs turn out to be higher than what has currently been provided for. That would be a risk, and that's how we actually look at this. Impact of the oil price, our oil price assumption is an average of $65 per barrel for this year. At the moment, the oil price is just over 70. Remember, but we said average for the year. We didn't say the oil price of today or of yesterday. And of course, there is another factor that plays into the oil price because you see, you don't pay dollars when you fill up your car. You pay in rent, so the exchange rate plays an important role. Partly the exchange rate had compensated because it had strengthened, but a combination of those, it depends which one, whether the oil price has risen faster than an appreciation of the currency. So we have highlighted that that could be a risk to the forecast going forward. However, remember that a rise in oil prices is a shock, and monetary policy can't respond to shocks. So if inflation goes up because the oil price has suddenly risen, we don't react to that. What we react to is what that increase in the oil price does to other prices in the economy. So to the extent that the other prices in the economy begin to rise, monetary policy responds to those other prices. Otherwise, this distinguished panel likes complicating it, and they say they respond to second round effects, but that just means the other prices that rise because the oil price has risen, okay? The impact of the trade wars in terms of the economy. South Africa is a small open economy. And obviously, when there are trade, well, you said trade wars, I'm a central banker, I see trade tensions rather than wars. So the impact of those trade tensions is that they constrain world trade and thus have an adverse impact on world growth. And as a small open economy, remember, we grow by producing things that we can sell to other countries. And when global economy is impacted, then our growth also gets impacted. Let me also say that in trade tensions, there are no winners. You start these things, you are not the one to stop it. And actually, there is evidence that already, there are, if you have time, read, there are 2 chapters in the World Economic Outlook, 3 and 4, huh? 2 and 3, that deals with this trade stuff. And it actually shows that the tensions between the US and China and the US and Europe had actually affected growth in all of those 3 economies. So there are no winners from trade tensions. The world just gets poorer because everyone thinks they can win by protecting what they believe is theirs. Meanwhile, we are all interlinked in the global economy. Isaac, can you rule out oil price fixing? No. The reason the oil price is rising is precisely because the bigger producers decided to cut on supply. So even if you are a monopolist, understand, you either control quantity or you control price. You can't control both. And they have decided to control quantity. So by cutting down on supply, they had managed to push the oil price higher. Is there something that we can do domestically? Well, there are only two things I suppose you can do. One is to understand that you do not have control of it. And then, of course, the other one is to try and find your own oil. And unfortunately, our geology has not quite allowed us to find, and even the one that we apparently had found offshore will not come on stream until a number of years have evolved. That is the point. Now, ESCOM, pressure from World Bank and Moody's. You see, as a young policy maker, one of the things we did in the build-up to democracy was to engage with the World Bank. And there was an old man at the World Bank who said to us, you see, the World Bank is a bank. Understand that it is a bank. And you see, if you have a mortgage and you do not service your mortgage, your bank will come and repossess your house. If you don't service your car loan, the bank will come and repossess your car. And he says, but the World Bank lends to countries. If the country does not pay us, we can't come and repossess your country. But by God, we will teach you how to budget. Now, many countries learned that lesson the hard way. That if you do not learn how to budget, and you end up running to the World Bank so that the World Bank should be funding you because you are living beyond your means, that will be a very expensive lesson in how to budget, my friend. ESCOM is not under pressure from the World Bank or under pressure from Moody's. Moody's is, my friend, like the weatherman. They are just telling you it's going to rain. Get yourself an umbrella or fix your roof. If you do not fix your roof, when the rain comes, you can't blame the weatherman because the weatherman just told you it's going to rain. That's all that Moody's does. And if you fix your roof, you will not have to blame the weatherman because the weatherman just told you it's going to rain. Now, you now say that, so why don't we just change sections 223 and 224 so that the Reserve Bank can then lend money or give money to ESCOM. Voila! Problem solved. The lights are on. Well, the world does not work that way. You see, the mothers and fathers of our Constitution were students of history. They foresaw this one coming, and they decided to protect the institution against those kinds of demands. This is called a central bank, and the reason it's called a central bank is precisely because it should not be engaged in those lending activities. Its job is to protect the currency. Now, what you are telling us by lending money to ESCOM is that you are asking us to print money. So, if what ESCOM is looking for, this central bank prints, that means you have flooded money into the economy. And the consequences are too ghastly to contemplate. And so, but why are we even having a conversation of a central bank having to lend money to ESCOM? It's a fiscal issue. It's a structural issue. Is the problem that ESCOM needs money, or the problem is that we need electricity? If we need electricity, then the focus should be on how do we get electricity. That is what we should be focusing on. And so, today we say, okay, we have got a problem at ESCOM, let us ask the central bank to put money at ESCOM. And tomorrow the farmers say that we think we should put money in agriculture. And tomorrow the manufacturers say you must put money in agriculture. And oh, don't forget the students, they have got university fees to pay for. So why don't we put money in education? Oh, by the way, we have got people who are ill. So the central bank must put money in hospitals. Oh, sorry, the roads too. And before you know it, what has happened is a classic fiscal dominance problem. Because what you would have done is to monetize the deficits. And the world over, monetization of the deficits results in erosion of the value of money as inflation runs amok. And before you know it, and trust me, we are South African. Before you know it, we will be in the streets protesting against the erosion of the value of money. The reason the mothers and fathers of our democracy and our constitution decided to create an institution whose job it is to protect the value of the currency was to stop that kind of populist policies from making the country poorer. Any other questions? Ma'am here in the middle, and Azar, and are you asking that I switch the light on, or you are also okay, yeah, in that order. Let's take those three and then I'll come to this side. Jenny, there is a microphone there. Yeah.
Hello, my name is Jenny Klupp from the German Embassy. I have a question concerning the return of capital flows to emerging markets. You had a slide there, and I think it was for emerging markets overall. And I was interested, do you have any data in how far South Africa so far actually benefited from the return of capital flows after the changes in monetary policy in Europe and the USA? And relating to that, what is in the current situation with a rather sluggish growth rate in South Africa, but the more benign external conditions? What's your forecast for the exchange rate, and how optimistic are you that South Africa will actually benefit from this improved situation? Thank you.
Azar?
Thank you, Governor. Azar Jameen from Econometrics. Governor, you've just returned from the conference, the big conference, and we would love to receive some of your insights. Especially, you've given a very eloquent exposition of why it doesn't pay to monetize deficits. Yet, what we are seeing is the world's leading central banks, again, pouring money or refraining from trying to normalize the monetary situation. And we've had a massive increase in world liquidity, which has just contributed more than anything towards rising inequality, which in turn has had huge political and social effects. What was the discussion there about? What is the end game of returning to refraining from monetary normalization?
Where is the gentleman who was standing at the wall? Okay.
Yeah.
Yes.
Peggy Maile, Channels Television, Nigeria. You just mentioned that it was mentioned that there were no quick fixes to the to growth, and you also mentioned that you have in the past identified the problem, but you didn't act towards the problems. I just wanted to know, would you paint a picture of in the rate that is going on now, with the things that are going on, with all the meetings that are being held, but no action is being taken? What does the future look like? What does the economic future look like?
You said your name is?
Peggy Maile.
Benny.
Peggy.
Benny. Becky.
Peggy Maile, yes.
I got you, Becky. There were two hands this side. Ma'am?
Governor, my name is Timakato Tukwana from ENCA. I just wanted to know, my question is sort of related to the gentleman. In terms of ESCOM and the load shedding that we've seen, if it continues at the pace that we've seen going forward, what is the expectation of, the effect on growth for this year? And have you been able to, or can you tell the effect of state capture on the sort of low growth that we've seen last year and what's projected this year?
Sir,
Thank you, Governor. My name is Nkululeko. The question that I have talks to the format of these forums. I just wanted to get an understanding as to whether, because I do see you at pains on TV trying to explain and explain away why the Reserve Bank, the change of the Constitution cannot assist the proponents that think that the Reserve Bank should be central to the growth and development of the economy. Have you ever perhaps toyed with an idea of inviting those over to the forum like this, and perhaps maybe you change the setup a little bit for that particular day, such that those that really believe, are hardcore believers in that, are sitting there at the front, they pose their questions, and then they make us understand where they are coming from, with the thinking that the central bank should rather be leading the development of the economy as against the setup that it is now.
Okay. Naidu, growth. Clearly, I didn't explain myself very well. You are a Becky. Oh, you can also deal with the last one. Thank you very much. I was wondering where I give it to. And then, Minale, would you deal with capital flows and also with the money, the normalization? And then, Rashad, would you deal with the forecast of the exchange rate and the effect on, exchange rate. Fundi, you deal with the effect of growth on ESCOM. Of ESCOM on growth. Okay. Minala, shall we start with you?
Thanks very much for splitting Jenny's question and giving the exchange rate forecast to Rashad. Jenny, in terms of the flows, I think what we have observed is that since the turn of events in terms of the change in monetary policy forward guidance, if you wish, and the easing of sort of financial conditions, we have seen a generalized flow, capital flows returning to emerging markets, and South Africa has been no exception. In terms of the actual figures, a little bit of a mixed picture. We've seen strong inflows into the bond market since the beginning of the year, and then particularly strongly actually month to date. So in this month we've seen up until now something like 12 to 13 billion. But if one looks at figures year to date, overall positive around 3 billion rand, but that is put together out of inflows into the bond market of about 31.7 billion, but outflows out of the equity market, or just under 30 billion. But in terms of the moves that we've seen with the return of capital flows, South Africa has benefited in similar fashion to what other emerging markets have observed in this period. Turning to Azar's question and a little bit of reflections from the meetings, I think the key kind of term that was being used, certainly by the people in the IMF, to describe the situation that we find ourselves in, was delicate moment. And that obviously recognized that while the global expansion overall is still relatively encouraging, the risks are tilted to the downside in the medium term. And there was an element of nervousness around how much, pretty much what you're saying, echoing that how much one should celebrate this easing of the global conditions and what we've seen in the markets. The markets also seem to be a little bit unsure about and unsettled, but clearly the risk is that people could then start taking undue risk, and sort of that this easing of financial conditions could mask other vulnerabilities that are in the system that are starting to build up, including corporate debt, which was very much of a concern. There was a lot of talk about, for instance, since the financial crisis, how much of corporates have been downgraded and are sitting right on the cusp of speculative grade, and how much in that environment they continue to secure huge amounts of loan and take up more debt with relatively light sort of covenants attached to their loans. So if things were to turn, that could create huge sort of ructions. And the other issue generally was nervousness, having to do with the fact that there could be renewed tightening of financial conditions, given that the turn that we have seen has come about relatively quickly, and it's been fairly short-lived at this stage. And so it was a little bit of a mixed picture, but I think on balance, more nervousness, issues that you also touched upon featured quite strongly with regard to things like inequality and the fact that there is a sort of general eroding of trust in financial institutions, the level of international cooperation sort of reducing and less support for that. Trade tensions, of course, featured quite strongly in terms of which way things might go. I think overall, some element of cautiousness and warning to policymakers that we should not sort of take and book this as a victory of some sort, given that the vulnerabilities are still building, and that policy mistakes should be avoided, certainly with regard to people thinking that these rates are going to be low for much longer, that we can go back and build up debt in the manner that the governor was talking about later. So a little bit of a mixed picture around growth and the expansion still being with us, but a lot more focus further out in terms of the risks that are sitting in the system.
I do.
Thank you, Chair. Becky, on the growth outlook and the forecast, let me start with a little bit of the history. Between 1994 and about 2010, 2011, the South African economy largely tracked the global economy. When the global economy was growing at 3%, we were growing at about 3.5. When the global economy was growing at 5, we were growing at about 5.5. Since about 2011, we've grown at half the rate of global GDP growth, right? And the reasons, so it's not the global economy that explained our weak growth. May have explained a small part of it, but if we're growing so much slower than the global economy, it means that they're mainly domestic factors that explain the weaker growth. And I think those domestic factors are known here. The governor has alluded to some of them, issues around confidence, issues around state capture, issues around the efficiency of our capital spending, issues around policy certainty. All of those explain that gap between global growth and our growth. So we do forecast a slight global slowdown from the range of 3.5, 3.8 down to 3.2, 3.3, but we're still only projecting growth of less than 1.5 for the next 2-3 years. Right? We're not yet at the point where we can confidently predict that we've solved those problems, domestic problems, so that we can again track global GDP growth. Right? Hopefully in a year or two, maybe we'll start to fix some of those and we can start to see higher growth forecasts. But at the moment, that's not in our base, in our base case scenario. So we've revised down our GDP growth estimate for 2019 from 1.8 to 1.3. But we do think there'll be a gradual rise back towards 2% by 2020, 2021. But even then, it's slower than global GDP growth. We'd have to fix those things to see a fundamental change in those assumptions. So your suggestion that we invite some of the critics and some of the proponents of a more developmental approach, I think is a good one. Thank you for that. We do engage with very broad stakeholders to try and explain the role of the central bank, but we can do more on that front. But let me state that the central bank does play a role in growth. A stable macroeconomy is a necessary condition for growth. Without it, you're not going to get growth, but it's not a sufficient condition. Right? We can play a part. If you lose your macroeconomic stability, you'll have even less growth. We think, and the numbers that Chris has shown, we think in broad terms, we've done relatively well to keep that macroeconomy stable, notwithstanding significant pressure from the microeconomic side and from other areas of policy. But it's not a sufficient condition. So in order to get growth going, you have to fix those structural issues in the economy, and that would lead us to higher growth. But the moment you say, well, let's lose macroeconomic stability too, I think the possibility of getting higher and stable growth is much less, not more. Thank you.
Kasim?
Thank you very much, Jenny. I mean, this is an interesting question because I think that, there are two ways one could answer this. The one is, we could discuss how we think about the exchange rate through the prism of the model that guides us. The other is we could look at it in much more intuitive terms. Let me address both. I think in the first case, it's quite important to bear in mind, and this may not be very intuitive for non-economists, is that what we assume about the exchange rate is we decide on what we think the ideal or real equivalent exchange rate is, and that's based on a model that takes into consideration terms of trade, savings, investment in the economy, your current account deficit, and on the basis of that, we assess whether the currency is overvalued or undervalued. So, for example, in our model for 2019, we make the assumption that the exchange rate is slightly undervalued, but when we go into 2020 and 21, it's slightly overvalued, and there's a whole process in which how that works. So if you look at our model, you see something called the real exchange rate gap. A negative tells you slight undervaluation. I think that the more intuitive way is very hard for us. It's very hard for us to say, if the current exchange rate is 50 rand to a dollar, where do we think it's going in the next couple of months? What is important for us is some broad rules of thumb that guide the way we think about risks in the model and the impact to which an exchange rate contributes to the risk of inflation. And there, I guess, I have no choice but just to give a very textbook answer, and that is, if we think that the monetary policy normalization process will last longer than what we otherwise would have thought, we take a view that has a more benign effect on the exchange rate. If we take a very negative view of a deterioration of South Africa's macro fundamentals and idiosyncrasies, we have a less benign view of the exchange rate. So I think that, I think at the end of the day, it's very hard for me to say what our forecast of the exchange rate is. The best we can say is what are the fundamentals and risks that we think affect the exchange rate, and that's quite an important part of the monetary policy statement. So when you go to the next monetary policy statement, an important part would be how do we think the global economy is going to affect the direction of the exchange rate, and how do we think domestic factors are going to affect it? Thank you.
Thank you, Chair. So load shedding will certainly have placed downward pressures on growth, and it's likely to limit production, and it will have adverse effects on investment prospects. However, when one is trying to estimate this, it's not an exact science. So one would have to take into account things like the electricity availability factor. It would also, the impact would also depend on which customers are being load shed and how often they're being load shed. And so what we've done is to try to estimate a range, and we provide a box on this inside it's in the MPR. Box 1 in the MPR gives you some detail on the work that we've done. So we estimate that the range of negative impact could range between 0.4 percentage points and 1.3 percentage points. So that's how much lower growth could be because of load shedding. But one would have to look at the combination of all of these factors. We don't have the exact cost on the impact of load shedding that we had until the end of March. Of course, one would need to get some detailed data from Eskom on this. With regards to the price effect, because there is the broader effect on growth, but there's also the effect on inflation, one would have to look at, for example, how much diesel Eskom is utilizing over and above what was approved by NERSA. So if, for example, they had made a request and they go beyond that request, there is a process that is run by NERSA through the regulatory clearing account where Eskom would go back to NERSA to say, we came and we requested X amount of money to utilize for the diesel generators. We've gone above that level, and so NERSA would have to consider that. So that's a public process that Eskom would have to go through over the course of next year, and that's something that we would take into account in the numbers. Thank you, Chair.
Okay. Estimate of state, how much the state capture has cost. One day we will know what the extent of state capture is. And once we have known what the extent of state capture is, we will quantify it to see what is the impact on the economy is. At the moment, we don't know what the extent of state capture is. Are there people in the other room? There's no one there. Okay. Right at the back, the man in a bow tie.
Good evening, Governor. My name is Yanni Rousseau. I'm from the University of the Witwatersrand. My question is the resignation of Deputy Governor Francois Groep earlier this year. We've not seen an appointment as a Deputy Governor to the Reserve Bank. As a result of that, we are seeing a bunching, for lack of a better word, of executive appointments at the bank. And at what point in time will that become a risk in itself to the operations of the bank? Thank you.
Thanks, Yanni. Right at the back there, next to Gerdas.
Thank you very much, Governor. I am Godfrey Mutaung from the Tshwane University of Technology. Clearly, there is a difference between surviving and living, and currently we can see that our economy is just surviving. Now, while the economy is just surviving, we also see the Minister of Higher Education and Training announcing the scrapping of historical debts of students. We also see the SANRAL with the scrapping of e-toll debts. And I also want to know how true is it with the amendment bill with its proposal to make provision for debt intervention for consumers earning a maximum of 7.5 per month and less than 50K of unsecured debts. So if that is true, how does that affect the economy, and what role does the central bank play?
Okay. Interesting. Say.
My name is Tabiso Baloi. I'm also a retired banker. My question is about SADC. I'm thinking about the role of the reserve banks in SADC. Is there any role they are playing in terms of protecting SADC and Africa as a whole? Because we have European Union on the other side. Yes, I know we're part of the BRICS, but at the end of the day, is there anything else that we are doing in Africa to actually try and uphold the little growth that some of our African SADC countries are having or are aspiring to? The other question is about if the UK comes out of the EU without a deal, how is that going to affect South Africa in particular as one of our important trade partners?
Thank you. Behind you.
Governor, I remember last time you mentioned the important role of the Reserve Bank to protect...
I remember you from last time, but I forgot the name.
I apologize. It's Rudolf Buitendag from Oranje Kas. My apology. I remember you called me an old timer that time. Governor, you mentioned the importance of protecting savers, people that save, otherwise there can't be people that loan. And you also mentioned today the stage where interest rates were 26%. I think the damage during that time is still has its effect on today. There was one time, I think it was in the 60s, late 60s, where if I want to buy a house, I was forced to pay a certain deposit. So that was the way of disencouraging people to spend too much to hold down inflation. Is it impossible to apply that in today's time? That was my one question. The other one is, I've noticed over the past years how savings unfriendly South Africa is. I watched the non-taxable amount on interest on savings, and it's diminishing each year. Every time the budget is submitted, the benefits of tax saving rent interest is decreasing all the time. It's not even kept in line with inflation. So we can't blame the population for not saving. It's encouraged by the authorities. And when I ask these two questions, I know the Reserve Bank is not in charge of the policies and the politics. They are trying to manage what is happening. But that is my two questions. Thank you.
Thank you very much. Naidu, protection of depositors, deposit on houses, taxing on savings, your baby, and then and the debt write-off is your baby.
Not mine,
Yes. And Mr. Minera, can you talk about no-deal Brexit, please? Okay. Kuben, shoot.
Thank you, Chair. Let me state up front that the Reserve Bank played no role in the legislation or the policy change to have a debt write-off, right? Through the Treasury, we actually submitted a comment to Parliament. We didn't think it was a good idea. And the reason why we don't think it's a good idea is that if you force institutions to write off people's debt, then those same institutions are going to be more reluctant to lend to those types of people again. So if you say, if you earn less than 7,500 Rand, I'm going to write off your debt, the next time somebody who earns 7,400 Rand goes into a bank and lends money to them, that bank is either going to say no or is going to charge them a higher price. So with good intention, it may be that this results in less credit flowing to the poor, and that may have negative welfare and economic effects. So in general, debt write-offs are not a sound option. However, if any financial institution has been found guilty of reckless lending or excessive lending in terms of the National Credit Act, then of course there are good legal grounds to compel that institution to write off debt. I think the same principle applies on the student loans and on the SANRAL debt, right? I won't go into the detail, but I think the same principle applies. On the loan-to-value ratios and on tax incentives, before the financial crisis, it was not seen as a monetary policy instrument or a macro-prudential instrument, but today it is seen as an instrument in the hands of the central bank, that if we think house prices are rising too fast, for example, we can say to the banks, we're capping the loan-to-value ratio of 90% or 80% or even lower to try and dampen growth in house prices. At the moment, that's not a problem. At the moment, South Africa does not have a situation where house prices are rising too rapidly and therefore posing a systemic risk to the economy. So at this point in time, that particular tool, which is a new tool in our toolbox, is still being kept safely in the toolbox without being used. On the tax incentives to save, I think as any central bank, we would welcome tax incentives to save, and we think that that should be promoted. There are, however, of course, complex welfare effects of tax incentives to save. The higher your earnings, and South Africa is a highly unequal country, if somebody is earning 10 million Rand a year and saving 3 or 4 million Rand a year, do they need a tax incentive to save, for example? So at the moment, there is a tax incentive to save, but it begins to erode at very high income levels. I think you've got to save more than 350,000 Rand a year before that tax benefit starts to decline. And there are genuine public policy issues, welfare issues about whether the fiscus, whether there's a social case for the fiscus to subsidize the savings of very high income earners. I think those issues are best dealt with by government, by the policymaker, and not by the central bank.
Very good central banking answer.
No deal Brexit. Very difficult question that. Obviously, what no deal means is that the UK would leave the European Union in a rather unstructured way. They will have no agreements in place that define their future relationships. They will all need to be renegotiated, also with other trading partners. Some of the issues that, well, basically, we're talking about a rather chaotic scenario, just to put it straight, because there are, for instance, certain laws in the UK that don't exist as UK laws, that have just been imported from Europe. So there'll have to be a new wholesale legislative program to sort of translate some of these laws into domestic laws. Border checks will need to be introduced. There are issues around trademarks where there have been sort of shared arrangements. All of these things would have to be recreated. Certainly also huge impacts that are already being felt, given that people couldn't wait and live with this uncertainty. The role that the City of London played as a major international financial center. Many of the banks, certainly from outside the EU, American banks in particular, had established themselves in London as their headquarters, and arrangements are in place that based on their registration in London, they could operate in the other European countries. All of those kind of things would obviously come to an end, would have to be renegotiated. Some of the banks are already relocating staff and renting places on the continent or in Dublin. There are massive implications that at the moment nobody can really foresee and say with certainty how that will pan out. What seems to be clear from what we hear from the Bank of England and economists is that the huge amount of knock in confidence will lead to a massive contraction probably of the UK economy. They've already been suffering as we speak from this uncertainty in terms of where they are. So it's a situation that I guess both parties would find undesirable and are, as you know, trying as hard as they can is to find some kind of arrangement for this not to happen in an uncontrolled kind of way. What it would mean for us is that we would obviously need to also negotiate some of the agreements that we have with the UK as a trading partner, which were linked to their membership of the EU. They would have to be then rerun as a bilateral agreements with the UK from a point of view of South Africa. From a real economy perspective, we are not that much sort of integrated with the UK in terms of imports and exports, but certainly from a financial perspective, we have our banks operating there, and a lot of the borrowing happens in London. So we are a small and open economy, as was said earlier, very plugged into a global financial markets, and the issue of disruptions that would happen around the City of London and investment flows that also, as I said, from US investors, banks, and all of that tend to run their operations in this time zone out of London would require us to renegotiate a whole host of arrangements to get back into some orderly way. It is a situation that would be undesirable, and I think the efforts at the moment directed towards some kind of deal and to avoid a no-deal situation, because everybody understands that would create chaos.
Thank you, Minele. SADC central banks, we meet in a committee of central bank governors in SADC to promote integration in SADC. But we are just central banks. So we focus on integrating markets, we focus on integrating payment systems. We have now a SADC RTGS, which facilitates payments across the borders in SADC. That's what we could do. The lessons from Europe are that these common areas need two important planks, which without you will not be able to do successful integration. The first is that you need a political union, so that decisions that are taken centrally can be applicable and enforced in all the other countries. The second, actually there are three. The second is that you need a fiscal union. In other words, that you must understand that you are one area, and there have got to be rules in terms of where the taxes are collected and what's collected centrally and how are the tax shared and allocated and so forth. And the third is that you need a banking union, because if without a banking union, the troubles of a bank in another country could easily spill over into another, given that you would be in a common currency and so forth. And it's a lesson that Europe, which is probably the most advanced integration area after the US, learned that problems in Greece and Portugal, in Spain and so forth could easily spill into the core of the Euro area. it is something that the political leadership in Africa needs to understand, that there are preconditions to having a union and having a common monetary area. That was the last bunch of questions. We are going to go out. Yanni, your question about Mr. Groep is above my pay grade. Those are executive appointments, and it's an appointment that gets done by the president. As you know, that the president, like many others at the moment, are busy with the important issues of the nation. He must be given the space to apply his mind and make a decision. From where we are sitting, we would prefer that that decision should have been made on the 1st of February. We are in April now, and we are awaiting keenly that the president will one day call us and says that this is who we are appointing to replace Deputy Governor Groep. Ladies and gentlemen, that concludes the proceedings for tonight. Dashanta, do you have any announcement about liquidity and stuff?
Thank you, ladies and gentlemen. Just a quick reminder about the feedback forms and to collect the monetary policy review on your way out. I think there's still quite a few lingering questions, so we invite you to continue these discussions over a light supper that will be served in the restaurant, that's the dining area of the bank. Staff are stationed outside and they will lead you to the venue. For those of you who are still trying to make up your steps for today, the staircase is also be open, so it will also lead you down to the ground floor. We thank you and we look forward to hosting you at the next Monetary Policy Forum. Have a great evening and get home safely. Thank you.